Talk to me honestly. I'm here. I'm here.
What's up, everybody? Good morning. All right. Taking a look, opening of the market. New trading month. Also one of those weird months where VIX expires after monthly S&P expires. So VIX expires it's either today or tomorrow. Either tomorrow or Thursday. Let me see. Usually holiday weeks they push it forward today. So let me double check. Next 2 days, whatever's gonna roll. I need to really double check on that one. But could be some volatility coming from that. VIX has been bottoming out. VIX futures down to low 14s. This is crazy, seeing no volatility. But this is supporting that short squeeze that we at Rocket Scooter been looking at since October of last year. We're the ones that called the bottom when everyone else is super bearish, and now we're continuing. Its monthly maps are showing a rally of October of this year. We'll see if that's still the same when this new map comes out. I'm excited to see. Y'all ready? Oh wait, I forgot to do that. I was playing with new transitions. Let's just put it on regular. I'm rebuilding the stream and rebuilding the show. We're gonna have our multi-face, multi-person show coming up pretty soon. It's about time for that. We're about to launch futures trading in the next in July, so that's exciting. We're almost done building it. I couldn't be more excited. This is extremely exciting. What's up, everybody? Good morning. All right, rational market looking good. Rational market, nothing crazy overnight, just sitting still, sitting pretty. We did tap lower DD band on Nasdaq. So there is no DD band pivot to be that rule that we look for. Touch lower band for the upper band, and vice versa. Once you touch the DD band once, that rule is over. The float rule and all that stuff is over, so we don't have any of those considerations today. All right. Hold on one second. Can't wait. Looks like we did on my screen. I could be wrong though. No, the DD ban, it starts on Friday. Hold on. Yeah, you have to base the DD ban on Friday, not on last night's trading. Overnight session. This holiday doesn't count. The bot's probably wrong. You don't trust the bot because I ran the bot yesterday and I'm pretty sure I messed up. Yeah. Just do the calcs yourself. Yeah, so we're opening, so Rocket's going to give you 3-letter codes, and the 3-letter codes look for where dealer positions are, and hedging are, and, sorry, institutional positions are and dealer hedging is. So the institutional positions today, we're opening on the bear side. So we have a bear short up, which is on SPY, and what that means is we've opened deep into bear territory just for today, so there's a little bit of selling pressure because of that. We also opened below hedge pressure, which is a negative gamma on sold options to dealers. So what we're seeing right now, these are the way that it works is if you're buying SPY and market makers on the other side of your trade, you buy or sell the shares, and they don't have somebody facilitating the other side of the trade, they take it, and then they go off and buy options from other market makers who write those options. And so hedge pressure is that balance from dealer to dealer that are trading against each other, and bull and bear is that position between you and the dealer on the underlying shares. So long story short, the institutions, we're in bear territory right now, and the market's going to run right up to 438, which is hedge pressure. With that, I expect resistance because of all that bearishness. The overall feel, or like the mouth feel of a bear short up, is downward. So if I break through 48 and the market does rally, well, we could push to 439, but that's going to be really solid resistance today. So I expect 438 to be an initial resistance point. And with the Russell pulling back, which is the next thing I do want to look at, is that Russell's opening without bullishness and bearishness, kind of like we call it liquidity pocket. That's balanced, but Russell's pulling back, so it's not bullish either. And QQQ obviously opening on the bull side of everything. So it's like the market is 3 different directions right now. With that being said, always keep an eye on the S&P if you're going to look for indication from all three of the indices. When one's up, one's down, one's sideways. The S&P typically is the horse that leads the cart. And today, it's not looking super bullish. A 438 on the S&P could create some upside in the market. But right now at the door, it's probably going to be resistance. That's kind of my interpretation. I'm going to run a monthly map in just a second and see how we look. Let someone else speak. But right now, it's not really looking like it's a really strong up day today. Not yet. Any chance the music gets turned off? Is it too loud or something? Oh, my bad. I forgot to turn it down. Dude, I haven't woke up yet. I'll be honest. I'm still kind of like... Oh my God. Look, it's been a long holiday weekend. Just see what happened to my car. Y'all follow me on Instagram or on Twitter. My freaking car, tire blew out. And then I got all this body work I'm gonna get done, like knocking out some dings and stuff while I was at the dealership. Been a long weekend. All right, so mean reversion long up. We're kind of stuck inside of here. Bear long up, we're kind of long up to bear zone with DD coming in close to 90. Any press through here is going to tap. So end of the day, we're pushing like essentially there. It likely is a short setup day. Obviously, with it being so strong, I don't take strong short bets. Today, resilience is positive. Resilience can predict hedge pressure breaks, so we're going up one more bump. My bad. I had the volume way up. Everybody, smash that like button on the stream really quick. I'm gonna count to 5, and I want to see that at least be 100. I'm gonna every morning. I'm gonna keep my mic muted until we see 50% likes of everyone viewing the stream. That's a new rule. You have to do your part, and I'll love you to death. Okay. Ready to see the analysis? You ready to see the analysis? I know it's a small thing. I wish you can automate that, right? Smash it. Still doing the ETF challenge. Yeah, still doing it. The thing is that Rocket Scooter now is going to have live futures trading. So let me make an announcement really quick. Make sure that you have Pro Plus Rocket Scooter, because Pro Plus is where futures access, futures data, and futures trading will be. You want the automated DD bands, you need Pro Plus. You want automated risk interval, you need Pro Plus. You want automated red line, yellow line, you need Pro Plus. You want to trade in your futures account, you need Pro Plus. When we have stock trading coming up, probably a month after this release, you will also need Pro Plus. The extended trial or the Pro or the Lite will not have trading, so that's the difference between the two. So you get your little pop-up deal that pops up on your platform, you better take it. Pro Plus is $200 a month otherwise. If you get that grandfathered in rate when we have our new releases, then your price will never go up. And if you get in like at under $100 and lock it in for life, you get the access to all of that stuff for the same price, and your price will never go up. So that's what we really have to make that announcement. If you snooze, you lose. So don't miss out. If you don't have Pro Plus, send me a message. Be like, hey, I'm in the extended trial and I don't want to miss out on futures trading, because if you're in the extended trial, you won't be able to play with it. That's Pro only. So the difference is live trading and futures data is going to come with that other package. Lifetime is also considered Pro Plus. Yeah, you're good. Lifetime is everything. So that's probably what most people end up doing, is like buying Lifetime outright, so you get full access to all the stuff that we have. Let's get a monthly map up. What's going on here? On my monthly map not showing. What? That is really weird. Why is monthly map way down here? There it is. That's an anomaly. I don't know if that's just on mine or anyone else's. That can't be right. Is this just on mine or anybody else's? Refresh fixes it. It looks like it's not updating SPY's data. It looks like it's not drawing SPY. It still has QQQs because it's stuck in the 300s. Yeah. See, this is showing QQQ's monthly map whenever that populates. Yeah, let me let him know that really quick. It's a very important day. We need to get that out. Let me see if the walls show. Let me do daily, single date. We're going to just manually build it real quick. Okay, so what I'm going to do is a little trick. So right now, today, the market I'm looking for short setups against these upper bear zones. So essentially a scalp from here to here. So that's what I'm looking for. Just a small scalp. It's still bullish-ish, but getting that resistance for the day. Let me see what this is. July. June 20th. Okay, we got the June. Holidays, probably. Probably because of the holiday. Who knows? Sometimes we get holiday effects. We do have data. So 440, 439. Let's run. So we do have the data to draw it. It's like every single data's there, so could be just holiday effect. Okay, so we need to get this. I gotta see what's going on with the pool. Okay, so today, appreciate you guys. Good morning. Good morning. How it's satisfying in 20. Yeah, let's keep an eye out there. All right, let me get my drawing tool really quick. Where is my drawing tool? Hold on 1 second. This is what happens to take 4 or 5 days off and get like epic and close down. It's going to screen somewhere. Okay. I have so many screens. I know it's on my screen somewhere. I gotta find it. My drawing tool. Where are you hiding? Oh, there it is. Okay, found it. Hiding on another screen. Okay. So, let me kind of draw what I'm looking at today. Man, I need those maps, though. QQQ still looks really bullish the same way. All right, so the S&P, resilience being positive. Resilience can predict hedge push or break. That is something we do look for. as res being positive. It's going to push it that direction and sort of pull back in there. That's what I'm expecting here. But I'm not taking that trade. You usually don't take trades for hedge pressure breaks. But you have to be kind of very cautious knowing that that is very possible. Like this. And then the bear short up has that resistance there. And then wherever res ends up being, it's going to pivot one way or the other. Clearly, when you open below hedge pressure, it likes to stay below hedge pressure. When you open in bear zone, it likes to stay in bear zone. So if there's any break from here, this is the peak. So this is the absolute top. Any kind of break from here is going to do that and then pivot wherever res says it's going to be and likely to close down in here. So the possible legs that we have today that I'm going to look for to take scalps off of. This is definitely a short setup day. There is clearly a short from there to there. There's a tap from there to there in case DD is bullish. So we have this kind of move in case there's a break. Res greater than 0, we're going to pivot to there, bump the next resistance. Res less than 0, and pivot to there, and bump next resistance as well. Typically, you open down here, you tend to close down here as well. So again, piecing it all together, there's scalps, a big scalp from here back into this box. I probably wouldn't take a short from here to continue to trade it lower. There's really not much room to hit that lower DD band, which is about right there. But I'd be looking for some of these to scalp against back to box. This is going to be a flat, choppy day today. There's really nothing to take from that. So there's not really a breakout day or a sell-off day today. No volatility, nothing. Monthly maps likely just like this because of the holiday. That's why I have to say anything. It shouldn't be. We have the data. For whatever reason, it's not drawing. So it looks like we still have a similar look to it. I don't know what's up with SPY, but who knows? We'll look into it. Taking a look at the DD bands, things are looking pretty stable here. Nasdaq is definitely pushing through the middle. The S&P is still kind of sitting at the bottom. There's really no evidence that the market's going to become bearish or sell off. There's really nothing here that's giving me that indication. So, you know, market's still bullish. It's just going to be, you have to find a good day with some good momentum. So I don't see anything really. Play with my windows here. Okay, so if you need to upgrade to Pro Plus, you can access live futures data and futures trading. We're going to have close to 80 brokers you can connect with. After we unlock that, the very next step is to have live stock trading and options trading. So we're going to be, we're going to have the ability to connect to more brokers than any trading platform on the planet by a long shot. We have a new technology that nobody has. We're going to be able to connect to that many brokers. There's going to be pretty much nobody we can't eventually connect to by the end of the summer. So if you have a brokerage account or multiple brokerage account, you want to trade through your Webull, you want to trade through your TD, you want to trade through your Tradeovate, all that stuff, we'll have the ability in some way, shape, or form for you to be able to trade via our platform through all your broker connections. So connect them all, be able to send orders and see everything all in one place. That's the ultimate goal, and that connectivity is something we've been working on for many years planning. And of course, you know, we don't always tell y'all while we're building it because we have to keep our edge in the market always. But that's always been a goal of mine since the start of this project. And it's taken a very long time to plan it all and to get it all set up, but we're finally excited to have it all going. You must be a Pro Plus member, which is our highest package, to be able to connect to brokerage accounts and see your data and do orders and everything. All right, so Nasdaq's hitting upper bear zone. And if you want to check it out, like I said, just tell me, you know, click your pop-up. It'll give you an offer. During your trial in the first month, you should see something there. If you have been here more than a month and you missed it, send me a message. I'll walk you through it. Options would be, we would do, the answer is yes with options. So we're going to build something even bigger when it comes to us doing our options, not just being able to submit orders. We'll have options ladder and all the stuff and some really cool tools that connect Rocket Scooter to options. Other than just a ladder. So neater ways to have your options. We'll be able to connect to Rhythmic. So Rhythmic is not a broker. Are you asking that because you use Rhythmic? For like prop firm or something? So we're not going to connect to a... We're not going to connect to another... Rhythmic is just a data API. So if you're talking about being able to trade through your Tradeovate account via Rhythmic... Hold on one second. They're talking about the space. So when I look at the letters, liquidity map gives you 3 letters in it, and in that letter code, we give you a little cheat sheet that goes with it that draws where all these pressures balance out. You have bullish pressures, bearish pressures, long gamma, short gamma. It's a bunch of, essentially complicated Greek words. If you don't understand the Greeks and options, it can be a headache to get in there and learn it if you're not a mathematician. So we try to make it very simple. Draw some arrows on a chart based on these pressures. Bear pushes down, bull pushes up, long gamma pushes up, short gamma pushes down, and which way do they all balance? If all these different forces, this is not just human trading, this is the algorithmic part of the market that we're looking at. These things are all done with computers, and algorithmic trading is controlling that balancing act. So we're exploiting that, and today this is a pretty characteristic bear short up is what bear long up is what QQQ said, which means you get this long upward pressure from hedging, but you get this bear resistance. So it went up, then it came down. And when I day trade, I like to scalp in those ranges that make a lot of sense. And I said that, today's likely a relaxed day with very little volatility. And as you see, the market's not rallying and going up. And Rocket Scooter across the board, pretty much SPY and QQQ are both in bear territory today. How do you trade it, right? This is another question below. I know Ashton has his hand raised, and I remember when a little bit ago, Paul was saying, it's bad when you're trading options. There's ways to trade. And in days like this where you have bearish pressure and long hedging that are pushing to the middle, I'm sure Ashton's going to chime in on ways to sell options, because that's typically what you would do in environments like this. It's like a sell option day. It's going to chop around and go nowhere. Then, you don't have to, on the sell side of options, you can collect premium. It's not going to break out. It's not going to crash, and you can probably, sell both sides of that. But looking today, this seems that we have hedge pressure being a resistance in SPY. That was expected. And 368, top of the bear zone, being resistance in QQQ. That's expected. There are really no trade ideas I can pull out of my hat today. That would have been it. That scalp up the bear, that scalp back the hedge pressure. Pretty simple. I didn't take it because it's just a little bit of run. But this is the time I'd be calling it a day and just kind of sitting out and waiting for tomorrow. What's up, Ashton? Easy as that. All right. Well, RS provide the data. That's one good question. We cannot provide the data for futures. You'll have to go buy your own data. But lucky for you, it's usually like $10 a month. And you have to buy it from your broker. But we will have that data tunneled through. It's the one extra charge you'll ever have to pay, because futures data is like that. And trust me, it's like that for everyone. You go sign up for like what it's called, Top Step, or one of those prop firms, they also make you buy your data, right? They can't provide the data for you. You can blame the futures industry on that one, but everybody's got to make their money somehow. So unfortunately, you got to go buy it. But these FCMs only charge you like $10 for it. Will NinjaTrader be one of your 80 available brokers to connect with? So let me tell you how the NinjaTrader section is going to work. It's not coming out in the first launch. NinjaTrader is coming out in the second launch of actual, what we call equities brokers. That's a different connection we're going to have. Certain brokers allow us to API connect to, where your brokerage account's actually connected to our service, and you get a two-way street. Others, like Trade-of-8 and NinjaTrader, it's only a one-way street. So you'll be able to submit orders to that broker, but you won't be able to tunnel their data into our platform or get account information in our platform and things like that. And again, that's their limitation. So as soon as these companies open up the ability for developers like us to do that, we'll be the first in. They have an API that allows you to just submit orders and get order confirmations. So we're going to essentially, every broker that has an API, we're going to connect as far as we can go into it. So the limitation there is that you can log into your Trade-of-8 account or your Ninja account and submit orders to them and get an order confirmation. But you won't be able to pay for the data there and get it shipped to here. It's a one-way street. AMP is on the list. Every FCM is on our list for futures. So you should be fine there. I'll have to double check, but I'm pretty sure AMP is on the list. There's no reason why they wouldn't be. Super excited. Iron Beam is the broker. Ali, you're using Iron Beam? Cotton Dog, the way that it works is, and again, this is a futures industry thing, you have to have a brokerage account to get futures data. If you don't, you're going to have to pay a lot of money per month from a futures data distributor to get futures data. So if you just want to like go open a trading account, I'm sorry, if you want to go open like a paper account with somebody and get live streaming futures data, they're usually going to make you pay $75 a month for each exchange. It's a lot. So the way that it works is they give you these educational data rates where if you have an actual brokerage account, they only charge like $10 a month for it. So everyone in futures goes and opens a brokerage account, even if you don't use it, and then pays for cheap data. The alternative is that we go out there and we get the ability to redistribute the data to you guys, but we'd have to build it into your price. So imagine Rocket Scooter being $200 a month plus $75 a month for each US futures exchange, right? You'd be paying ridiculous amounts of money for it. So the way that the industry is very complicated. It's like we're talking about, it's very complicated, but you'll just go put a couple $100 in an account if you want futures data, and then just have it, whatever the requirement is, and they make you make 0 trades a month or 1 trade a month and pay $10 a month for data. That's the only way it can be done without jacking up the prices here, unfortunately. So to get futures data, you still have to do the same thing if you're trading futures. Yeah, our goal was to make it to where it's as affordable for you as possible. And so we had this talk of how we would do it. Now like I said, we'd have to create a Rocket Scooter futures a la carte. You buy the futures data you want, and then it just becomes really expensive. And the overhead's tremendous for us, and it just didn't make it as a lot. We'd have to buy a whole bunch of extra servers to have that data come in, distribute that data out, and then we'd have to charge everybody a whole lot of money for it. And we're like, let's just do the workaround, because we've all done that as futures traders. Anytime you ever wanted live futures data for yourself, you just went and opened a dummy account somewhere just to get the data. Right? Like with NinjaTrader back in 2015, I think the same thing. To get my NinjaTrader working, I put money into like a Philip or Dorman account, and they charged me a little bit a month for that, and I never used it. I just used the platform, had the data come through. Same thing that they did 6-7 years ago. Same exact thing. So yeah. Yeah, so if we could connect to AMP, it'd be correct. It'd be the same thing, Chase. I think I'm almost certain AMP's on the list. I'll publish the list when it comes time to announce further details. But just to let you know, I'm very positive AMP and others will be on there. Yeah. Justin Nate says your cousin works in compliance at CME. She says they are on the hunt this year. What are they on the hunt for? Just Nate. I'm reading your old comments. Do I pay attention to candlesticks at all? Absolutely not. So it looks like we're pulling back in all the major indices a little bit. I think that this is an interesting time just to kind of reflect on what we've seen the last couple of weeks. The market's been very bullish, and just kind of a little reasoning why. Markets move mechanically, and this is one thing I want to teach everybody. So we do a lot of education as well at the Rocket Scooter group, and one of the things that we teach is why markets move, and it's not really what most people have been taught, right? There are mechanical reasons markets move as well, and there's a lot of interesting things that a lot of you maybe in the audience haven't heard about before, which is really cool. And I invite you all to come today. I tweeted a link to my YouTube show, and after YouTube, we're going to pile on the Zoom, and I'm going to do a really awesome webinar and demonstrate a lot of the new features and go over some of this information. Especially if you're an investor or just passive, and you want to see, other new modern things that you didn't know about. Markets don't just move on patterns and candles and shapes of chart and trend lines and things like that. The markets never moved on that stuff to begin with. It's very extensive curve fitting. Markets really move on basic principles of supply and demand. And you'll see right now, the real reason this market is still not coming down is a mechanical reason. There are a couple reports we look at that paint a very solid picture that the market is stuck and has to go up. It has to go up, or there's bigger risk to the market makers that are balancing it. Where we are right now, is a very clear and easy to see short squeeze, and there are actually longs going long in the market. We'll talk about that today in our Zoom session, so everybody's welcome to come check it out. In general, we are, despite fundamentals, they're still very bearish, and the bear market will eventually catch up. The idea is not to guess every bump up that this is the time to short. We can pinpoint to the future where this risk starts to shift around, and it's months away. There's still people stuck in bull positions. There's still sold calls in the money, which forces the call sellers to buy. In futures, the market makers still have a net long position, and they never allow the market to collapse and crash when they're holding a long position. And net sum, they continue to raise the price until people buy from them. So these are things that have existed in the market that professional and institutional traders know about. These are things typically not taught to retail. And Rocket Scooter's whole entire credo, we're bringing institutional power to retail and teaching you what really moves markets, positions, hedging, these reports that show the market's bullish and stuck bullish, so that retail now has kind of the ability to kind of compete in this modern world that's like a space race with really fast technology, and everyone's kind of still stuck like pulling out their markers and crayons and trying to draw colorful pictures on a chart. I mean, that's how people trade in the 60s, and it just doesn't really give you some headway anymore. The modern market needs some modern tools, right? So that's why our passion project is, we're a team of engineers, and we've been building things that are really sophisticated under the hood, but they're very simple in presentation. So we invite everyone to come check it out while we're here. I see Paul has hand raised, but click that link in my tweet, and you can come to YouTube show, and I'll give you all a link to the Zoom call. What up, Paul? Thanks, bud.
Yeah, I just wanted to say,
Okay, what's up? Oh, you're saying CME for non-compliance? It's interesting. I subscribe to the CME enforcement actions. It's one of my favorite reads. You can go to the CME website and subscribe to various things they publish. And one of the things is every single time they sue somebody or somebody gets an enforcement action, I always like to read about it. I love reading that news feed. And it'll be like, so-and-so got busted for spoofing, so-and-so got busted for wash trading, different client accounts, and it's neat to see. I learn a lot about how the market works by reading those enforcement actions, because they talk about, this is the rule that got broken, and you're like, oh, that's a rule. I didn't know that was a rule. Can we exploit that rule? Can we find trade ideas from that rule? It's neat, and I'm glad that they're cracking down on stuff. And because the more they crack down, the more visibility you get. Like in these lawsuits, they tend to reveal a little bit about this rule was exploited, or this thing was changed, or this thing was broken. And the more they talk about, the more we learn about the machine, which is kind of cool. Using asked about candlesticks because he had a bearish breaker. Candlesticks, I'll just be honest with you. Candlesticks mean nothing. Candlesticks have no, these are things, and I always talk about this, but these things don't mean much. They're good-ish, but they're not actionable. It's, like I said, it's curve fitting at the best. Looking at, because this happened in a candle, this will happen in the price. It's never really worked out well, and candles, I think, are the weakest way to look at the market, because you can change the duration of the candle, by just changing the duration, like which one is the right one to give you the right answer. There's not one. And I tend to not look at candles. I don't change the time frame. I don't look at historic price. Never. I don't even look at, do y'all ever notice that about my trading style? I don't look at historic price. You never see me pull up a chart unless I'm just referring to, marking up gaps. I never look at yesterday's highs, yesterday's lows. None of that stuff means anything, and I still trade 70% win rate or better. I don't look at historic data. I don't look at different candles. I look at what's going on right now and what the positions are right now, and that's all I care about. It just proves a point that at best, any kind of what I call shape data, shape of the candle, shape of the chart, which is trend lines, boxes, pennants, flags, whatever, at best is a neutral move. You're not going to get any additional information. If I can get 70% without it, it just proves that there's other ways to see the market that I find more effective, right? So any questions about what y'all see on the charts today? You should look at the COT map. Yeah, good idea. Let's look at COT. Let's bring it up. So COT is a positional data report that we like to look at. Oh yeah. You can see that the dealers' positions are now getting close to zero. This is a nice effect that could be the end of the bull wave. This is what sustained the bull wave going up. It's right at zero, and we were right at zero and fell below for the first 3 months of the year. And you can see that the market became turbulent. You don't normally see selling pressure until dealers themselves have gone negative, and it looks like on the COT now, we always read this every Monday, have finally begun to go negative. What that means is it's going to show there could be some choppiness or some selling. The market waits for dealers to no longer be negative for it to come down. That's a great thought, William. So it doesn't just mean that it's imminent, but it means that it's coming up soon. Now, how soon? Well, that's a question that we don't know. Now, keep in mind, it doesn't mean that the market will crash when dealers are negative, but it means they don't crash when they're positive. That's the rule. So when they are positive, it doesn't crash. When they are negative, then you have to kind of take another approach. Now, remember, dealers going negative is characteristic of a bull market. When the dealers are going more short against buyers, that's typically what happens. There's more buyers than sellers. Dealers will go short. And the sellers are as short as they can be. I don't think there's any more power for them to go short. This is a very short setup. And there's people still willing to buy. I see you both to come up. Let me read. So this is a great thought because the commitment of traders is a very important report that can give you some future insights in the market. So let me go back and show you what it looks like. So normally you can safely assume that when the dealers are very positive and as long as there's buyers, the market just moves very rapidly. As soon as you see, and this is very characteristic of like the post-COVID move. I mean, it looks exactly the same. Consolidation breakout, and then dealers went negative. And it wasn't like, okay, the market's going to collapse, because as long as there are buyers, the price always goes up, right? Dealers bought the dip and held the bag, and as long as people are willing to buy from them, they're going to continue to sell and then short to them until you exhaust the buyers. And you have to exhaust the buyers for the market to finally come down. So now with this being negative, it could get a little turbulent, but it is not going to sell off until the green line starts coming down. That's the next step. So we're going to step ahead. Does everyone understand that? The green line is the asset managers. So as long as they're willing to go more and more and more long, the rally still continues no matter what the shorts are doing. And the market is very short right now. So as long as people are buying, it doesn't matter who's buying. If the blue is buying or the green is buying, the market will still go up until the green exhausts. And that's pretty normal. Like an example here, right? Green is going up, blue is kind of sitting flat. And then right here, right when the green started coming down, the blue also became the buyer. So the shorts started covering and the market still went up. And then the market only came down when the green was coming down and there were no buyers. So you're looking for both green and blue sloping down, and that is your inflection point now. So I just gave you guys the most important piece of information you've had of your entire trading career. And if you don't write this down, you're going to be behind. Okay, ready? As soon as dealers are negative, repeat. You want that exact point in time when the green and blue are both pointing down, and that's when the market turns. You see that? As long as there are buyers, once the dealers have held the bag, as long as there are buyers, whether it's them or them, as soon as they're both pointing down, that's how you know sentiment's shifting. We got it? This is like 10, 15 years of advancement of your understanding of the markets in this one sentence. As long as there were buyers and the dealers held inventory, they will continue to raise the price, whether it's longs going long or shorts covering shorts. And as soon as the green turns around, which usually happens first, the market gets a little volatile. And when the blue squeezes out, as soon as people start shorting again and people start selling again, then the market pivots and comes down. It's exactly what happened here. You had green selling, blue selling. It doesn't matter. When both people are selling, markets come down. That's what you have to see. So the safety net of, well, markets don't crash while dealers are positive, well, that looks like to be over. They're slightly negative now. So now the dealers are just exhausting their inventory and selling to willing buyers. As long as they're willing buyers, which there are, it looks like that number is going more positive, then that's great. And it looks like this number tailed up as well. So you have green and blue both going up. It's very, very squeezy still. Okay. So you need the blue line and the green line to both be trading down. And that could take months to quarters to pivot as well. All right. Okay. Love teaching y'all things. Oh, you like that, Lee? It's like, when you think about it, it's so obvious, right? It's literally just buyers and sellers, and people are buying, markets go, and people are no longer buying, markets come down. And the basic analysis of it is just like identifying where buyers and sellers are. And it was the whole inspiration for creating the Rocket Scooter algorithm as well. Where are the buyers and sellers? You have to remember, market's irrational though, because you are outside a DD band. So irrational market, you have to be careful with resilience, right? Irrational market on DD band basis can cause resilience to be delayed. Like if the S&P is selling before the stocks are. It tends to happen more in irrational markets during squeezes. So today, just kind of be cautious. Res is positive, so you do have some pressure there pushing up. But I'm not going to use res in an irrational market to pivot the trade, right? So the bear short up is pivoting against the box, right? Resilience is giving that upward boost there. Bear short up is getting that downward pressure there. This was great scalp. That was great scalp. And that pretty much ends the day. Everything else from here is going to be kind of random. Positive resilience states that, you know, it's going to want to come inside the box and support here, but you're going to get that downward pressure there. So the market is going to fight inside of this range here. And when you're irrational, we don't assume that stocks lead the index. So we don't use resilience unless it's greater than 10 or less than negative 10. And it's slightly greater than 10. So I consider this positive, but when you're outside of DD band, this typically I don't trade anyways, right? DD band is right here. So for me, it's I don't use resilience outside of DD bands, personally. Yeah, as Broke Sabbath said, so that's correct. Like when you've moved this far, its resilience can be delayed and lose its leading edge. Okay, hold on. Crypto's collapsing. You hear about the BlackRock versus SEC. So market direction is run by inventories. Well, market direction is run by market makers who are required to buy and sell. to keep their job as market makers. And then, of course, they do something consistent after they buy and sell. They hedge to zero, and that's repeatable. And so we identify where they bought and sold, and then we know where they're supposed to hedge, and that's what we've done. And so if people are willing to buy, they're going to raise the price if they hold the inventory. If you own something and there are people lining up to buy it from you, just think you're going to raise the price, right? If people are betting against you and shorting your market and you hold the inventory, you set the price. You don't have to let them win that trade. You can keep the price where it is and keep them where they are. I think my thing is frozen. Let me double check. Let me do this really quick. Oh, yeah. Right? So it's a supply and demand thing, and it's a control thing as well. So if there are people willing to buy, you're always going to raise the price, especially if you're holding inventory. And you get to choose, like if people still want to buy, you can shorten. I'm going to borrow shares. You're going to continue to buy. I'm going to borrow from my friend and sell them to you. As long as people are willing to buy, I'm going to keep raising price. Right? Even if it's people that bet against me and they finally have exhausted their bets, right? I'm going to raise the price even faster to squeeze them out. And the idea is basically that. And market makers will buy when we dump to them. They'll short when we buy from them. And it's just basically analyzing that. There's a few easy rules that we take from it, is that markets don't crash when dealers are net positive. It's never happened before, and makes sense. If we've dumped all of our inventory to them and they're now holding most of the stuff and there's no market anymore, there's no buyers, no sellers, nothing. We've exhausted the selling and they hold the inventory. The price stops crashing because now they hold the bag. It's like if you bought everyone's junk that they sold and now there's no market, nobody's buying from you, and you hold the inventory, you're going to lower price to look for buyers if you need to find buyers, but you don't even need to find buyers. You're the buyer. Just hold on to it until the market conditions change and then raise the price to attract buyers. And that's what they always do. So dealers don't crash the market on themselves and bankrupt themselves, and they have that control not to do that. Another thing is in a regime like this, where we dumped everything in a recession and everybody's betting short, the market's not collapsing because buyers stepped in, then the shorts are getting squeezed, they're becoming buyers themselves. You have two waves of buyers with dealers holding the bag. It's kind of like you built the hot restaurant in town and everybody wants to come eat there. There's no way you're going to lower your prices. You're going to raise prices until people stop coming. And this momentum from that doesn't stop until the buyers stop and everyone starts selling again. And that's what you have to wait for. And that's repeatable. And you can actually see that in the COT report. If you go back and study it, you'll see that. Hold on one second. 1 second, Cotton. Give me a second. I'm on a podcast right now. Give me 2 seconds and I'll walk you guys through this in just 1 second. I'm about to talk. Okay. Okay. All right. What's up? Okay. Back. Sorry, I'm talking on a space today. All right. So today, easy bear short up. You can see, right out the door, this is exactly what we do. You get here, you get your liquidity map front and center. You look at it, bear short up shows that general downward pressure off of hedge pressure. General downward pressure off of hedge pressure. Easy to see that. I didn't take a long because it's bear short up. Easy to see. Any break, like I said here, this is the maximum upside. I said we're kind of trapped today and going nowhere. Didn't make any trades, didn't do anything. So now on this one. Res is positive, size dropping. Yeah, Ross said DD bands so much. What's the difference between LC and FTR? Oh, and the commitment of traders report. Is that what we were talking about? Why is this doing that? If you're talking about the different reports, one of the reports is looking at commercials versus speculators. Commercials are people that are selling and buying contracts because they're transferring the commodity, against people that are buying and selling the contracts who aren't intending on buying or selling the commodity. Think of like weed or oil or oranges or something, right? You're just a trader, so you're a speculator. If you're a farmer, you would be a commercial. So that report looks at those positions, how they're spread out. And then I think like 15 years later, they came out with this report because traders wanted to know a little bit more detail of how the speculators were categorized. So like there's a million types of investment entities like hedge funds, annuities, 401ks, mutual funds, investment banks, big banks, the Federal Reserve's in here. Like how are the people that are speculating or hedging in this market positioned? And it's a subdivision of this. You got small commodity pools, you got large commodity pools, you got federal investment banks, like I said, anybody that's in your hedge funds, IRAs, all those categories. You want to see how they're all positioned against each other. Who's betting long, who's betting short, but not really ever going to hold the commodity. Okay. Yeah, the SPY's coming down today, and where I think it's going in the long haul, still bullish, but this is VIX expiration week as well. You're just going to see a little bit of craziness. It's good to see a little downside move today. Not going to buy this dip, going to let it relax. Cotton Dog, you know nothing about your product. Your models analyze the same dynamic of things like gamma, flip over, call wall. Yes, but the difference is we're the first in the world to actually crack the code and reveal dealer positions. Everyone else that looks at this style of analysis basically takes the open interest of the options and then looks at that and analyzes based on Greeks or whatever. So all of that stuff, name a system out there. They claim to do dealer, they claim to do market maker, and it's all baloney because they look at just the open interest, which includes speculators like you and me. It includes everybody's buying and selling. We look for, in the order flow, evidence of a dealer position because we know how they're supposed to operate. We filter all the options. We throw a lot of the options out from our analysis. They don't even matter. The evidence that we do it right is very clearly seen by a distinct bull zone and distinct bear zone. Very little overlap. Somebody messaged me the other day and was like, what do you think about this? They talk about this and that. Hold on. I'm gonna make fun of some random product because these things are, look. This is what happens when you do a heat map. I don't know if I'm just gonna share really quick. Okay. Oops. I'm gonna cover up like here. Somebody sent me this. They're like, oh, these guys do kind of what you do. And I'm like, what do you mean? You go, well, yeah, they're showing like dealer positioning. And I go, what do you mean dealer positioning? Where are the bulls and bears in this? Well, it's like, okay, you have bear, bull, bear, bull, bull, bear, bear, bull, bear, bear. What? Like you can't action. It's not actionable. We have one bull zone and one bear zone because we algorithmically determine where that risk is spread. So like things that like people show me these things and like, oh yeah, there's people that are kind of what you do with this, what people do with this kind of stuff. GEX does something similar. All they do is they take the ladder and they take the entire ladder of options and multiply it by some Greeks or some whatever, and they get you this distribution. But this is so noisy, you can't act on this. And that's what pretty much everyone that looks at options does. What we took it a step further is we algorithmically filter out most of the noise to find the real bull and bear zone. Because we know that a dealer is going to engage in a position that'll be hedged to zero. So if there's a 100,000 share long and we can identify the dealer is going to short and buy an option, we know that's a dealer position as long as that long is still active. So we actually go many steps further than just like the heat map groups and cumulative delta, cotton, all these different types of technologies out there are an entry point to the understanding that options can predict very strong pivoting in the market. But the noisy factor is what they all are, very noisy. You really can't, as a trader, plan around that. And I like to pull this up because they all look the same, and this is really easy. You can make this in Excel yourself, but you can't really, like, where is it bullish and bearish? I mean, it's bull, strong bear, little bull, very bear. Like the market's been very bullish. How can I tell that from yesterday's printout? Where does this say bullish? So the idea is that it's the idea that people are starting to go in the right direction. But people say like gamma flip level and things like that. And when they say call wall, ours is a little bit different in that we're not looking at the open interest alone. I mean, it's part of the analysis, but it's a very small part of the analysis. We look at the order flow, and the option existing doesn't mean it has meaning, and we filter out the ones that don't have any hedging on them. So the next, it's the ladder turned sideways, basically, right? So what's cool about what we do, Cotton, no, we just like to chit chat on our stream, about to go to a Zoom call in a little bit, is that we actually find a risk distribution for anything. If you type in Apple, for example, you can see where bulls and bears are positioned. You can see that Apple is stuck in its bull zone. It's actually really stuck in a bull zone way up here. Apple doesn't become bearish until 170. So people that like sold calls, for instance, are forced to buy. That's keeping Apple elevated. While other things like the index is falling in a bear zone, we've actually entered a territory where there's going to be more bearish hedging than bullish hedging, right? Hedge pressure is where dealers are positioned and hedged. I'll prove it to you. Hedge pressure is the maximum, right? If you want to take one sentence view. If we take all the options that exist and remove only non-dealer options and leave just the dealers that bought those options in this particular trade. If I long Apple, right, I buy the shares and I buy a lot of them, and there wasn't a seller on the other side. Market maker had to short the Apple to me, right? So they're down that amount of Apple. And then temporarily, until they find a seller, they're going to buy the calls weighted by delta to neutralize their risk to zero. Okay, so dealers have options, and this is a particular trade example. I long shares, they short shares and buy calls. So they're short the market and long the market at the same time. If they weigh those calls appropriately, then they're in a neutral position. So a big in for neutral. The thing is that these dealers bought calls from another market maker of the options. So this is the market maker of the equities. This is, I'm sorry, of the stock. They're quoting the bid and ask of the stock. These are the options writers. This is the market maker of the options. So they're the ones that have sold that amount of calls. So you have a dealer to dealer trade right here. So they bought insurance. These guys sold insurance, and these, to hedge that call going in or out of the money, they got along the shares, right? Or short the shares relative to delta as well to offset their risk, because they're trying to neutralize also. Okay, so as you see, this particular arrangement, I bought stock from a dealer who bought options from another dealer who's forced to buy and sell the stock, thus completing the circle of a buyer finding a seller. Okay, does that make sense? So now what we actually do is, because we can identify this and this inside of this environment, these calls indicate this bull exists. So in Apple, the fact that there's all of these calls that are held by dealers of the stock means that there's bulls in Apple where there were no bears. Clear as that. Hedge pressure, if you give me like 5 or 6 tickers, I'll show you this. Hedge pressure is the maximum gamma of all options at all expirations balanced to today's risk of options sold only to market makers by other market makers. We filter it this way. So gamma max is highest change of delta, which means the highest change of the option relative to the underlying price, or in another way, the highest order flow due to delta hedging. So at hedge pressure, it is the highest order flow of those sellers of the options buying or selling the stock. So anytime you touch hedge pressure, it is a volume spike every time, and it's actionable, no matter what. If you give me any stock, I'll prove it to you. We've found the dealer balance point, and is the most important number in trading, where market makers are shifting their risk over. Anytime you interact with hedge pressure, you're going to have a volume hump. Now, this one's not as pronounced, but it's still there. You can pick anything that crosses hedge, and I'll show you. So if our models are right, Every single time I print hedge pressure, which is the dealer balance, it should show volume. Maximum gamma means maximum delta hedging. So any stock that you touch that hedge pressure, no matter what it is volume. Just crossing through it. This little candle, look at that volume spike. Do you see that? This is dealer capitulation from one side to the other. It is a perfect pivot for any stock, which I love about it. I'm just putting in random stocks. Anytime you cross and interact with it, look at that volume balance. Look at that high volume. It's higher than the open. This is proof that we've done it right. Every stock, we predict where the volume will be from dealers hedging. You see that? So the gamma is positive of those dealers being forced to buy to offset the sold options. And now the gamma is negative that forces the dealers to short. They capitulate. They go from long to short. Pretty cool, right? Give me any stock. The fact that we can pinpoint this for any stock means our model's universal. So we actually cracked the code. It's kind of nice. Can I show futures? We don't have futures data yet. So SPY will predict to futures pivots entirely accurate. These pivots in SPY will pivot the futures, and SPY hitting its own hedge pressure. This is weekly options. We also have a hedge pressure for monthly options as well. So the new month is very far away because it's the start of the month. It's not even actionable. So right here, you see how you're interacting with hedge pressure. There's volume interaction as you sell from it. Volume spike. So max gamma makes humps in the options volume. It's humps in the underlying volume, actually. Because if the gamma is net negative here and net positive here, then the order flow is going to be selling. The order flow is going to be buying it and a net. So more long than short, more short than long. But at the balance point is the maximum gamma. Therefore, the small change in delta, small change in price in the underlying is the biggest change in delta, which means the biggest order flow. Because when you delta hedge, you're going to buy one share for every 0.01 delta, right? So if delta changes the most here by people trying to hedge their sold options to zero, they're trying to buy as much as they can to neutralize, then this is the maximum spot where they will buy. This is a high volume pivot predictable at the start of the day. So because we open below and it's hitting that net negative gamma, I'm in not a long mode today, right? And it says make humps in the options volume. So it's not going to be showing humps in the options volume. Those options already exist. This is going to be humps in the trading volume of the stock. Trademark pending. Tickle spots. The idea, and then what you do is if you know that the gamma is negative, then the order flow is just going to be more short than long. So you can literally just draw an arrow that says down here, there's resistance pressure. If we open above here, then there's support pressure. You're going to get like a wave of buying and selling that gets stronger the closest you get here. Because you know that everybody knows gamma does this, right? So gamma is the highest change in delta, which is another way of saying the highest order flow. And if it's the highest order flow of people trying to maximize their order flow to neutralize their position, then the highest order flow means the highest volume relative to all hedging. So at any price, we've identified the spot where options will be hedged the most. Anytime you touch hedge pressure, you see a volume spike. It's never wrong. The fact that you can see volume there proves that our theory is correct. We've identified dealer positions. At this one, anytime you trade off of it right here, volume is spiking just because you're there. Anytime you touch it, like right here, volume is spiking just because you touch it. So the neat thing is that that's how it works, yeah. So you're pretty much near it. And so when you piece it all together, we have something called a liquidity map, which is really cool. These letter codes basically give you a bunch of information all at once. Bear, short, and up, they represent, on the flashcard, this particular setup. You have that short hedging pressure from here. This states if you open below the monthly, which we're not, this one doesn't qualify today, so this is like way off the chart. But you have resistance from hedge pressure towards monthly hedge pressure. This number 3 right here. And that's exactly what you're seeing. because you can draw all of these lines. So bear pressure is there from the bear side. S is if you're below there, long as you're above there. So this is the gamma and delta hedging of market makers. So today it's short today. So you get short hedging and short position or bear positions together, and clearly not enough day. And you can see that the resistance pretty much caps out at that blue hedge pressure, and you can see right there. Pretty clean, right? So you just match the letters with the flashcard, and it just shows you that net sum of positioning and risk. Do you have to be a member to get into the Zoom call? You don't, but we'd love for you to check it out. You can get the platform and play along with it. It's only $35 and you can cancel anytime. And it's only for for 3 months. So you guys get to try out like the $200 full platform for like a very low price, which is kind of cool. Invite y'all to check it out. I mean, you really can't. If you're trading, you should easily have $35 and support our development of our platform. We love you to death. Go here if you'd like to sign up for it. Go here if you want to check out the Discord. Okay, let's do a quickie little look at QQQ today. Similar thing, you can see that shift, right? As dealers go from positive to negative when you interact with hedge pressure right here. Same thing, that tiny little candle right here is a huge volume spike with that interaction point. You see how that works? So dealers have flipped from long to short, and when you break through hedge pressure, it creates a gamma delta squeeze. So anytime if you're long the market, even let's do the same analysis, right? So that bear short up, you can do that same analysis here. You have long pressure there, short pressure there. This is the bear side, which is resistance pressure there. So you can see that there's like, if I were to just throw a ping pong ball into like these airflows here, right? It goes up and then comes down and has a balance point inside of there. If you break this, then it starts to accelerate to the downside because you get that capitulation on a hedge break. And the volume becomes erratic when the market makers lose control of the market. So you break through hedge pressure, as you see, volume is erratic as longs are getting squeezed against their will, which volume gets even bigger on a hedge break. Hedge break triggers something called irrational. If you break to the upside or downside, it can cause irrational squeezing. So when I trade, I can pivot from here to here. I wanted to take this short today is what I said, but I actually just didn't do it. From here to here, and I trade between volume pivot to volume pivot. Cool. It's like the Garanimals of trading strategies. What is Garanimals? Is that like a snack? Like Dunkaroos? The kangaroos that you dip in the frosting? How old do you think I am? Click the month button on your top right. Monthly or map? QQQ still bullish until September with waves along the way. I'm definitely over 40. Tilden, you're saying monthly for SPY? Yeah. Quickly, to show you guys irrational market, because we're outside of these DD bands right here. So this is like, I don't trade in the zone. I just kind of stay and avoid the market there. So as soon as we break through here, market's considered irrational and random. So I'm very careful to do anything once you've moved outside. This is another technique that we teach. So right out the door, the market's just irrational. Let it fall. Let it be crazy. I'm not going to go too detailed into trying to analyze that further, but I know there's downward pressure. How far does it go? Obviously, clearly bounce off of another yellow line, which always has support there. This is another technique we teach. What we do here at our community is we teach you ways to predict volume. Each one of our pivots that we teach you how to do are volume prediction techniques. So when you're trading, you want to trade where there is volume. Like, you don't want to trade at random spots that don't matter. We can identify where volume will be, and we can predict volume before it happens. Similar to hedge pressure, anytime you crash through one of these green lines, this is a thing in futures exploits. So this will be in our platform as well very soon when we get our futures data. But when you intersect one of these right here, anytime you cross through these lines, creates a problem in futures, creates high volume spikes in futures. Anything right here, anytime you touch these, we call them DD bands, there's a futures spike as well. So basically all volume, we're mapping out reasons for all volume that exists. High volume spike off of just this band tap shows that we're exploiting another thing related to futures margining. And when you break through here, it creates a different kind of effect in futures. And again, this is completely different in hedge pressure, which is based on options. This is based on futures margin requirements. The idea that we broke through this is a high volume pivot as well. So anytime you break through these bands, is a whole different protocol that, because futures have now sold off a little harder than expected, markets are going to be irrational and random and likely subject to margin calls. And that's why we see a lot of erratic volume once you get on this side of the band. Market is very high volume as all the squeezing is taking place. So we exploit a bunch of different things, which is pretty neat. We look at futures and we look at the index side by side in equities, and then completely find high volume pivots for multiple things. This is hedging and options. That DD band break, which created all this erratic activity, has to do with futures creating that problem. So when you look at both at the same time, you get a really cool effect of mapping out where that volume is going to be, which I really like. There it is. So is there any reason to see a back test back to the bottom of the box once it's broken below? Or once below and pulled away, all bets are off in price direction? So the idea is, it depends on what kind of trading you're doing. If you're just day trading or scalping or swing trading, you're going to analyze the market differently. Let me give you an example. Say that I'm swing trading, okay? Let's start. I'll say that I'm long the market. Let's say I'm just long the stock, okay? I've been long the stock since last October, and I wake up and SPY is bearish, and I go, okay, bear short up says that there's resistance from there and resistance from there. So the first takeaway I can say is, okay, crap, I'm long, it's probably coming down. So either A, I can stop out on my long, or B, I can hedge my own position. How can I hedge my long? I can either buy puts or I can sell calls, right? Well, if I know that I have resistance here and resistance there, and how far can it fall? It's hard to tell. We're irrational and markets are random. But what I do know is a very low probability that we end up here. Bear zone tends to stay bear zone. Below hedge pressure tends to stay below hedge pressure. So I can immediately take an approach that no technical analysis can ever do for anyone, is say, I don't think market's going to go here. It's not going to spontaneously become bullish. There's no category. Or sorry, there's no catalyst to create that bullish move. Can you see that as one? Why is the music loud? Okay, hold on. Let's turn the fucking music off. I had it turned all the way down. Here, turn it off. Okay. So do you see that, like, I can say, okay, it's probably not going to be bullish, right? So say I was long the market with this knowledge, what I'll do is, okay, why don't I just sell calls right out the door up in this bull zone? If the market spontaneously becomes bullish in the rare instance that it does, well, my long's making money. That was the intent. And I just get out of the calls. If the market just jolts around and does nothing, no matter what it does, I made money with the calls every moment they're out of the money. So I'm selling calls against my long as a swing trader to keep me from getting a margin call or having to stop out of my long. Does that make sense? I made infographics to explain how DD works, Colin. So I'm going to show everybody. I very highly encourage you to go check these things out. We have made infographics, which are making them for everything to show how everything works. So to answer your question for DD bands, you can answer your own question by going to the infographic. We're getting through all of them. But if DD ratio is bullish, here's what it states. If you open in bull zone, it supports a bull zone. If it opens in mean reversion, it tends to want to move to bull before bear. If DD ratio is bullish, which it very much is. If you open in the bear zone, then the highest it can go is the bull zone tap only. But I have to use other tools to make sure I know. So do you understand that this, you're asking, why is the bear zone the top resistance of very high DD? Because you always trade the next resistance when you trade. So while that does state from the infographic that the highest I can expect is that, I always trade to next resistance, and there's plenty of them along the way for me to scalp at. I don't normally trade from here to there to get out, even though it's possible. I always exit next resistance no matter what. So with DD positive, it does mean that if we're in mean reversion, like I said, it breaks the tie to there. If we're opening bullish and we dip to here, it returns to there. And if we open bearish, then this is the high of the day in my betting. If there's a catalyst, it can close up here short. That's like a 4% chance, right? In the back test. So when I'm trading, I always exit. I always get out of the way there. I don't care what DD's doing. And I always trim at first resistance, which is there anyways. I've got two resistances along the way. I've got short hedging and I've got bear side. So if I trim and hold a runner and trim even further and hold a couple micros, maybe to that. But I'd exit everything here anyways, right? So it depends. If there's no resistances in the way, then I'd, like an example. If your trading day looked like this, right? Your redistribution zone wasn't there. And hedge pressure was, okay. Say that I opened here, right? And resilience was positive and redistribution zone was up there. Then I can say, okay, I can long to here. My first resistance, take some profit, and then hold a runner to there and exit the whole thing. If there's a clear path, I'll sometimes trade it to there. But there's 2 or 3 resistances in the way, then it makes no sense for me to be so overly bullish despite positive DD. DD doesn't tell me, it tells me that it prefers moving to the bull zone from the middle, but it doesn't tell me it will enter the bull zone. But it says if it does, I'm going to, hold on 1 second, they're talking to me. Like, that's how I predict my high to be. Does that make sense? Okay. Yeah, so today, to kind of walk you through, if you come to the Zoom call, and everybody just go to the Discord real quick, send me a message, get the platform, and I'll explain more in a Zoom call. We don't really do education on these YouTubes. And actually going to stop doing YouTube for like hours at a time. I'm probably gonna do like a 30-minute YouTube show, and then we're gonna immediately go to Zoom and start doing education on the daily. So everybody go really quick. I'm gonna get out of here. Go to the Discord though, and we'll continue our talk there. I'll detail everything because it's like very, very, very cool stuff we have. It's completely revolutionary. Everybody knows that. There's a reason we're growing so fast. We've got 4,200 user accounts in our first year. This is crazy. We're now hitting our first year anniversary. I never thought we'd get so big so fast. I thought we'd get huge and we'd take over the world one day. We're taking it over faster than I thought. Rocket Scooter is the future of trading analysis. Finding out where market makers and institutions are positioned is the next wave, and presenting it simply and easy to follow, so you don't have to get a math degree to understand the complexities of Black-Scholes, saving you a whole lot of effort in figuring out how options actually work, and just kind of showing you where things are and give you some simple, easy ways to follow where positioning is, because it doesn't matter if you're bullish or bearish. It only matters if they're bullish or bearish, and if you can see where they're positioned, then hey, maybe you can have a better understanding of the market. And the visibility and lifting the hood of the market and showing where the market makers are is the future of analysis. So come over to that Discord, get a Zoom link up a little bit, and come on over and we'll do a nice seminar and kind of show you how a lot of these techniques work. And trust me, it will blow your mind.